Tip number one is to use supply and demand over support and resistance. So first of all, a support level is simply a level that the market has reacted from multiple times like this. And the concept behind this is when the market comes back to this level, we could buy expecting the market to bounce again. A resistance is the same, but the opposite. So it's a level that caps price. And the concept here is when the market comes up to this level, we would look to sell. Now, there is one big problem with support and resistance, and that is liquidity. That is going to be the topic of the second tip. But for now, let me show you why support and resistance isn't that great and why supply and demand is a better approach. So if we were a support trader and we were looking to buy from this level, our trade might look something like this. We would have a stop loss under the lows and we would be pretty much expecting the market to tap that level and go. So that would be the trade we look for. Now, as you can see though, when we let the market play out, this is not always going to happen. In fact, a lot of the time, this isn't going to happen. The support and resistance doesn't have much logic behind it. All we are actually looking at here is a line we've drawn on the chart, and we're expecting the market to bounce from here simply because it did before. But why would this happen? There's no significant logic behind it. Now, another way of trading support and resistance is the break retest strategy, which is the concept that when we close below a support, we would look to sell like this, targeting new lows. But as you can see, this rarely works out either as well. Now, this all comes back to the point of liquidity, which I promise we will cover in just a couple of minutes. But you're going to see consistently that the win rates on the support and resistance style of trading are pretty bad. So this trade now would have been lost as well. Now, what we do following this move is form once again a resistance level. So we had support, turned resistance, turned support. Now we have formed a resistance at this high to the next high. So we pretty much have the tap here, and the concept then is to sell from resistance. So we would have traders selling from this point with stops above the high, expecting the market to move down simply because the market has bounced from this level once again. As you will see, however, once again, this does not work out too great for the support and resistance trader. The alternative, and in my opinion, better style of trading is with supply and demand. Now, a supply zone is simply an area in price before a large down move that indicates a large amount of institutional selling took place at that level. Now, because significant selling took place at that level, that tells us that that is a good price area to sell from. Therefore, if the market gets back to this level, we can presume the same institutional participants will be happy to sell again. So we could expect a significant reaction to occur. Demand zone is totally the same, but just flipped on its head. So it's a consolidation area before a large up move. And the concept is when the market comes back down to that level, we will be looking to buy because we expect that this is a discount price that people will buy from once again. So when we take a look at the example where the support and resistance trader just got absolutely destroyed, first on the buys, second on the break retest, and third on the sells, if we look over here to the left, we can see that we have a consolidation before a large down move. This large down move indicates a huge amount of institutional selling, which are commercial banks, trading firms, firms with huge amounts of money that are able to drive the market. They see this as a discount price to sell from. So we would assume if the market pulls into this region again, it's quite likely we get a selling move again. So as a supply and demand trader, we would place sells at this supply zone, stop losses above the zone, and targets down into wherever we wanted to target. The concept would then be, if this zone is filled, we should be triggered into a nice trade, which will run us down to our targets. And the theory behind this is, of course, that we are following the institutional flow of orders. This is an area where huge amounts of selling has taken place. We know that because there's a significant push down. When we're looking at the support and resistance, we're only looking at small choppy movements generally, which a lot of the time are going to be caused just due to market noise. Now, you can see when we trade with the significant structure of the actual supply and demand, we are following these higher volume, higher momentum moves, which means we lose less trades, we have more of an understanding of what we're actually trading, we're going to have higher trade accuracy, ultimately less stress, and make more money. If you want to learn all about this concept, click the card somewhere up here or in the description. I made a full class on this topic teaching you deep about supply and demand and why it's better than support and resistance. So tip number 2 is to always consider liquidity. Now, liquidity refers in its simplest format to orders. And basically, the market is moving at all times due to orders. The whole reason the markets go up is because there's more buying than selling. And the whole reason that markets go down is because there's more selling than buying. So if we can work out where significant numbers of orders lay, we know where the market is likely to, number 1, be drawn into, and number 2, reverse from. So one example of that is the supply zone that we just talked about, which is the supply up here. The market came in, we know there's significant selling orders here, so the market is likely to sell from those regions as it did. But another format of liquidity is equal high and equal low liquidity. And this comes into the concept of support and resistance that we just discussed. So leading back to the previous example where we talked about the first support, we have 1, 2 equal lows. That's why we call it equal low liquidity. This is basically a support floor. Now, if you remember how we positioned our trade, and by the way, support and resistance is an incredibly common concept, the most common concept in trading, which means tens or hundreds of thousands, if not millions of people are taking the same style of position. Now, with that theory, when we see support, we look to buy. Where does our stop loss go? Our stop loss goes beneath that level. Now, in its simplest format, what is a stop loss? Well, a stop loss is an order. It's an order to get you out of a trade for a loss if the trade goes against you. So if you were buying at this level, your stop loss is a sell order to sell the contracts back for less than you bought them for so that you don't take any further losses. So with buys at this level, we know there are going to be stop losses below. And with this being such a common concept of trading, we know there's going to be a significant number of orders at this level. We also know that there's the break retest theory, where when the market breaks, we look to sell here. So there are going to be more sell orders in the form of manual execution sells after the break, and also sell stop orders, which are orders to automatically trigger you into a sell once the market breaks. So basically, we know under this level, there's going to be a huge collection of different orders. So this significant quantity of selling orders acts as an area of potential reversal, because when the market comes into this area, this number of people selling can provide liquidity to institutional buyers who may want to buy the market en masse, and they can because there's so many sell orders on the other side of their trade that they can get in easily without having to stagger the market. Because if you're trying to enter a trade with tens of millions or hundreds of millions of dollars, you will drive the market before you get in. This is a way around that because there's so much liquidity and so many conflicting trades that you can pretty much buy in against the amount of people that are being stopped out here, and that can form a reaction in the market. So because there's a significant quantity of orders here, the market is likely to be drawn into it, which means if you're trading support and resistance, you are likely to be stopped out. However, we can actually use this to our advantage. And if we start to see these levels get swept out, we can look for opportunities for potential reversals after a sweep of liquidity. So let's go to another pair now, and I'll show you an example. Here we have an area of equal lows. This could be seen as a support floor. So basically, the market has reacted from this level multiple times. So buyers are looking to buy from here if they are support and resistance traders. Now, because we know there are going to be a lot of people buying here, we know there's going to be a significant quantity of orders below in the form of sell stops and stop losses. Therefore, if the market is able to reach under this level, there will be a significant amount of orders for potential reactions to lead into reversals. Now, as you will see, there is actually a significant reversal after these equal lows were swept. And the market then trades all the way up to target new areas of liquidity. If you take a look here, the market has pushed up into an area where we have multiple equal highs. This is because there's going to be more liquidity above this level because of the resistant sellers and anyone selling in this range that has stop losses above the high. So markets will constantly push back and forth for liquidity. As you see, the market slows down once we sweep this high as well. So you can watch these areas for, number one, potential targets. If you were able to buy here, you would have been able to lead into a buy targeting that liquidity as a simple, clear target. And number two, for getting into positions. If you were to use some other concepts like market structure, you could have identified the break here and then use that concept of supply and demand we spoke about previously to actually find a buy to target this level. Because we see the liquidity has been swept, the market is now changing direction, we can use demand to follow the movement through. So by identifying and using liquidity to your advantage, you'll be able to see these kind of positions happening a lot, and you'll be able to read where the liquidity is above price and below price, and use those areas to formulate trades, both as entries and as targets. If you want to learn all about liquidity, I have a full class on that, card at the top of the video and link in the description as well. Tip number 3 is to use real market structure in your trading instead of focusing in on subjective concepts like trend lines. So one big error that traders make is trusting in trend lines. A trend line is basically the same as a support or resistance, but it indicates an uptrend or a downtrend. So what we would do is link 2 or more lows, and the concept is then when the market bounces from this level, we can buy because we're expecting the market to continue up. Now, sometimes this is going to work for 1 or 2 bounces, A lot of the time though, after the second bounce, it will give way. Now in this example, we would have potentially gotten a successful third bounce. And now we would be looking at this fourth bounce to actually buy. So trendline traders would say, okay, the market is in an uptrend here. We will look to buy the market. And the alternative scenario would then be, because they think this trend line indicates real market price, if the trend line breaks, we should look for a sell. So if the trend line was to break, we should look for the market to retest that trend line and then sell. But there's a problem with this, and that is that trend lines don't actually indicate the real market structure. We should actually look at market structure in the form of highs and lows. So we are looking for four things: higher highs and higher lows, and lows and lower highs. These indicate different trending directions. So a market that is consistently forming higher highs and higher lows, like this one, is in an uptrend. A market that is forming consistent lower lows and lower highs, like this one, is in a downtrend. And we are using the real market price to see this. So we are not just focusing on lines, we're seeing, okay, what is price actually doing? Is it going up? Is it going down? And the big problem with trend lines is that because it's not actually indicating a real trend shift in the market, you're going to be trading against the real direction a lot of the time. So take a look at this example. If we were to fail here and the market was to break under this trend line and you were looking for a break retest sell, well, you are a lot of the time going to lose that trade. As you can see just here, where we got a light retest by the small amount of sellers here and the institutional movements take the market higher. Now, the reason that this happens is because you are trading against the trend. Just because your trend line has broken, which is simply a line that you've drawn on the chart, doesn't mean that the real structure has. So let's follow up this structure then. We have this high, then we have this higher low. Then we have a new high, then we have a new higher low. That is then followed by a new high into this price area. That is then our higher high. And then if you look at the real structure, all the market has done is come down and form a new higher low. So for us to actually validate a change in the trend, what we would have had to see is actually a break under this level, because that would have broken the previous higher low and indicated that we were shifting into lower lows and lower highs, which would indicate a change in the trend. When you focus in on a trend line, as we just did here, you'll see that you're actually trading sells in a market that is continually buying. And now if we bring in the first tip I shared with you about supply and demand, you'll see that the market actually reacted from a demand zone. So just here, we have this consolidation move before the large up move here. That is a demand zone. So instead of using the trend lines and support and resistance, if we focus on using real market structure and using supply and demand for our entries, we will get higher probability trades. So rather than being on the losing side by buying here and then selling the retest and losing twice by focusing on trend lines, we could instead say, okay, the trend is clearly going up, so we can look to buy. We'll use demand to buy, stop loss below, targets into new highs, and as you will then see, a lot of the time, this is the market movement that is going to play out. We are following the real price and the real volume in the market to take the higher probability logical trades. As you can imagine, I have a class on market structure as well. Card at the top of the video and in the description. Let's move on to the next tip. Tip number 4 is to incorporate top-down analysis into your trading strategy. Now, if we were to look at this market as it is, we might be fairly confused on what the market is likely to do next. We don't have a whole lot of context here. So trying to trade off just this one single lower time frame alone is going to be rather difficult. However, if we start to zoom out and look at the markets from a bigger picture downwards, that will give us a better idea as to what the larger market is doing, which is going to give us better odds of taking trades that make sense. So for example, if we were to start at this higher time frame, we could see that the market is actually forming lower lows and lower highs throughout its trend. So this is pretty much a downtrending market on the higher time frame. Now we can also see that the market is currently reacting from a supply zone. So in a downtrending market where we're now reacting from supply, a trade idea we might look for is a sell. So now when we go down to the lower time frames, and this is why it's called top down, you start at the high time frames and move down, we could look for a possible reason to sell. We know that the higher time frame trend is bearish. We know that we're in a high interest potential area for bearish reversals. So if the lower time frames agreed with that, we could start executing a trade. Well, now by going down to this time frame, which is the 4-hour, we can see that after reacting from supply, we've had a break of structure. This is a new lower low after a formation of continual higher highs and higher lows. The market is also trading within this supply zone. So what we could do now is sell from supply and look to target new lows in the trend. We built the narrative here on the higher timeframes, so we have a lot more theory and reasoning behind why this trade should work. Obviously, when we were scaled in just looking at, for example, the 15-minute, the 5-minute, the 30-minute, or the hourly, we don't have any larger context. We wouldn't have known that we were in such a significant area, and we wouldn't have really been able to identify this previous trend either. All we have to work with is just a small area of price action that's not really given us any context on the position. But when we use this top-down analysis process, where we start on the higher timeframes and scale down to lower timeframes to identify agreement across timeframes, that is going to give us the highest accuracy and also make us aware of the big picture narrative and where the market's reacting from on those weekly and daily and larger timeframes. Those higher timeframes are the most accurate, so if we can build a narrative there, we can use the lower timeframes to execute our positions. And yes, you guessed it, I have a full class on top-down analysis. This one's a really good one. Check it out using the card at the top of the video or the link in the description. Tip number 5 is using momentum to validate your trading ideas. So taking a look at this market, we have two phases. We have this upward phase here, which is a low momentum phase. Now, momentum basically refers to how fast or how slow the market is moving. You can see here that to make these movements up, we have a lot of choppy price action, lots and lots of wicks, small candle bodies, and it's taken quite a long time as well. You can actually see though on the downward move, we have very large, very fast candles with very little wicks. And these candles close below structure, which indicates a change in the trend. Well, this tells us that the buying pressure is weak and the selling pressure is incredibly strong. It tells us that sellers are in control of the momentum of the market, not buyers. So what this can do is help to validate trades. Now, if we were looking to buy, but we were seeing a market that was this slow, this choppy, and actually struggling to push up this much, that could keep us out of the trade. We could think, okay, this does not look like a market that I want to buy through because we're not seeing significant strength from the buy side. However, when we see a reversal like this and a reaction like this with such huge, fast momentum, which is actually overwritten days of price action in a very small period of time, we now know that the sellers are in control and the sell side would be the better side of this market to get into. So when we see strong momentum like this, we can actually look to take advantage of it by selling from supply zones, as we covered in tip number 1, and targeting wherever we wanted to target deeper into the trend. Now, if we see how the market plays out, you'll see that it's going to favor the significant momentum, which is that selling move. As you can see here, the momentum on the down moves is so much stronger than the momentum that we saw on the up moves. And that gives us what we need to see to understand who's in control. Now, another way that this can come in handy is actually avoiding losses. If you were looking to buy, for example, from demand here in this trend, but then you saw such significant, strong, fast downward candles, you could consider here, well, the buying pressure that we're seeing in this market is evidently not as strong as the selling pressure. So any buys you were looking at from, for example, this region, you could look to avoid instead. So if momentum is coming against your position very, very quickly, that can be the factor that saves you from taking a loss. Because if you see that huge momentum and it's totally against the direction of the trade that you're looking to take, you can just avoid taking the position and save yourself some money on an unnecessary loss. So use momentum to validate your trades and always consider who's in control. You can work this out by looking at the wicks and the speed of price action. If candles are small and choppy like these ones, this is not strong momentum. If candles are full-bodied with small wicks and very fast like these ones, and these ones here, that is high momentum. And we want to trade with the high momentum party, whether that is the buyers or the sellers. Surprisingly, at the time of recording this, I don't have a class on this yet, but it's coming soon. So if you subscribe, it'll be up soon. So the modern trading space is pretty twisted. Most people have got things totally wrong and they don't know what it actually takes to win as a trader. So I've brought out a new masterclass, which is totally free. It's going to help you to reframe your mind to a realistic outlook of trading so that you can win without the huge up and down swings, the depression, the frustration, and the confusion. In it, I teach my logic-based technical strategy so you can get to know the concepts I use personally and see some real trade examples of how to put them into action. And I will show you what it really takes to win and lay out a blueprint you can use to start building a thriving trading career. You can watch that right now. It's on my website. Click the top link in the description and that will take you straight to it. And regardless of what level of skill and experience you have, I know it will help you to become a better trader. So go check that out. Thank you for watching this video and I'll see you in the next one.